R. Nelson Nash coined the phrase and wrote the book, Becoming Your Own Banker, the Infinite Banking Concept. In his books, he makes the point that you must have a banker's mindset or be a good business person in order to succeed at infinite banking. In his mind, that meant that while there is no actual requirement on the part of the insurance companies that provide the policy loans to repay the loans, you must repay the loans. You don't necessarily have to make monthly payments to repay the loans, but according to Nash, you want to be successful with infinite banking, you have to have the banker's mindset and repay those loans with interest. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I am the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I've focused on and specialized in the infinite banking concept and the tax-free cash growth warehouse finance strategy. In this video, I'm going to examine policy loans with regard to infinite banking and answer the question, is it necessary to repay policy loans in order to be successful with infinite banking? A couple of points I want to make before I dive into this specific subject at hand. One is that while Nash coined the phrase and wrote the first book about infinite banking back in the 1990s, the actual strategy has been in use for nearly 2 centuries. So Nash didn't actually invent infinite banking. He merely invented the name for the strategy and quantified the way he personally used it. And he was very successful with it. But he wasn't the first to employ the strategy, not by a long shot. And he isn't the emperor of infinite banking. I would argue that John D. Rockefeller was supremely successful with the strategy well before Nash got onto it. Now, I mentioned this before, and I'll state it here again. Nash wasn't completely forthcoming in his explanation or description of infinite banking and the way the accounts work. For one thing, the only rider he actually talks about is the paid up additions rider, or PUAR. And this is what I personally object to. He talks about paying yourself interest as you repay the policy loans. But that's not how it really works. It's true that some companies will allow you to pay extra into the PUA rider anytime throughout the year and without additional underwriting. That's true. But that isn't allowed by some of the very best companies for infinite banking strategy. With companies that don't allow random additional deposits to the PUA rider, you can dump in additional amounts, but it must be done on the anniversary of the policy, and it requires additional underwriting. In any case, while you may think of it as paying yourself interest on your policy loan, it's not. You see, the policy loans are provided by the insurance company, and they use the cash value of your policy as collateral for the loans. The money isn't coming out of your cash value, it's coming from the insurance company when you take a loan. The company then charges a specified interest on the loans, and that interest becomes due on the anniversary of the loan. You can't pay additional interest on the loans, and the interest does not go to your policy cash value. What you can and want to do is to have your account set up with a scheduled amount of PUA rider, which is paid as part of your total premium. That's what goes into the cash value of your policy. And again, you can add additional unscheduled PUA according to the company's policies. Now, the interest that is charged on policy loans does absolutely need to be paid, at least annually. You can make payments on the interest anytime. You can also make payments on the loans anytime. But again, that money goes to the insurance company that provides the loans in the first place. But do you actually need to repay the loans in order to be successful with infinite banking? Well, that really depends on what your specific objectives are. If your policy is designed properly and is with the right company, whether you repay the loans or not, your cash value will continue to grow with the compounding dividend interest. So it depends on how you want to use the strategy and what you want to use it for. For example, if you want to use the strategy to pay your monthly living expenses, then yes, you do need to repay the loans each month. Otherwise, you won't be able to continue to use the strategy to pay your expenses and earn interest on the same money. If you want to use the strategy to fund your fix and flip business or any other ongoing business inventory or expenses, then yes, you need to repay the policy loans regularly. But if you're using the strategy for occasional financing of, say, vacations or household furniture or electronics, etc., or even to pay your income tax so that you can earn interest on the money you're spending, then no, you really don't have to repay the loans. What? That's right. You don't actually have to repay the loans if you're not using your account as a kind of a sweep account to fund things on a regular ongoing basis. So really what it comes down to is, how do you personally think of success? What does success mean to you? For example, I have a client who has about $40,000 saved in their tax-free cash growth warehouse. And while they pay about $5,000 a year in premiums, their account now grows by about $10,000 annually. Yeah, they're earning 100% on their deposits per year right now. And that will continue to multiply because of the compounding nature of the account. But because they have leveraged about $30,000 of the cash value and have not paid back those loans, they only have $10,000 available to leverage currently. So what do you think? Is that successful use of the strategy? Well, let's see. They deposit $5,000 into their account and it grows by $10,000 or more. Sounds pretty good to me. And of course, they have the option to repay as much of the leverage loans as they want, anytime they want. That will make more of their funds available to leverage. But either way, the whole amount of their cash value inventory is continuing to grow, compounding. To me, that's the most beautiful aspect of the strategy. You can spend the money and it continues to grow more money for you at a compounding rate that just keeps getting better and better every year. So, is it absolutely necessary to repay policy leverage loans in order to be successful with infinite banking? No. It depends on how you want to use the strategy and how you define success with the strategy. It's certainly a good idea to repay the loans when you can. It makes more cash available for you for leveraging. But whether you repay the loans or not, your money keeps growing in your account. And that's really how infinite banking doubles the power of your money. You spend it and it just keeps on growing more money for you. It's better than Reese's peanut butter cups. Not sorry. If If you found this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. Now, for a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our 60-minute webinar on demand. The link is in the description box below. The link to buy my books at Amazon.com is also below. If you'd like to book a free phone consultation with me, the link to my Calendly page is also below. And if you'd like to apply to become a client of ours, the link to the application is also below. We're here to help, and we look forward to helping you. For now, aloha and mahalo for watching.